Run your day with Runday.ai.
Glenn, hello. Happy Thursday. How are you today? I'm calling from Fort Lauderdale. How about yourself?
I'm great. Nice to meet you, and thanks for inviting me.
Where are you calling from today?
I'm in Jupiter, Florida.
Well, Jupiter's really nice. I'm looking at Stewart up there. Hopefully the Bright Line will open up and there's some nice areas over there, and then have access to Bright Line to get to Miami when you need to.
Right. There's also Tequesta above Jupiter.
Mhm.
It's another area that seems to be growing rapidly.
Well, tell us more about what you're doing for your clients at Tycon.
Well, Tycon Partners has been in existence over 30 years now. We were founded in 1995 in New York City, and there's two parts to the business now. The main business is investment banking. Our tagline is providing pathways to the public markets. We specialize in helping early stage companies get to that next level with growth capital and or IPO. And these days you can do an IPO and raise up to $75 million every 12 months with a new regulation.
It's every 12 months. I see.
Yeah.
I didn't know about that.
Yeah, it's Regulation A+.
Are you seeing a lot of companies doing that?
I'm seeing some companies do that. I personally, my background is I'm a former CEO of public companies, private companies. And what I saw as CEO of a public company is the worst place to be is have a stock that doesn't trade. And so the company I was CEO for, 55% of the shares were owned by the family. Shares traded by appointment. And so you don't have the liquidity when your shares aren't trading. There's no real liquidity to that paper. So I prefer to use Reg A Plus as a starting point to get my clients to the point where they want to go, which is to have a share, a stock price and shares that trade actively and create a real currency, because you can then use that currency to acquire other businesses and you can collateralize, et cetera, et cetera.
What kind of business is this appropriate for? Do they have to be super profitable, have a nice EBITDA, or just be growing at a certain clip?
Well, you don't necessarily have to use Regulation A Plus to go public. You could just use it to raise money. And so the companies that do use it to go public can raise up to 75 million. But the problem they then have is they've created a non-liquid stock, basically, because typically the money's raised through placement agents, not through an investment bank that has institutional and retail clients. So after the IPO on a Reg A Plus, if you just have placement agents, there's very little aftermarket support, which is crucial to having your stock trade. So in the company I was the CEO for, even though I took the company from 60 some odd million to 110 million in revenue, the stock didn't move. And that was because there was not a real liquidity in the stock to reflect the value in the company.
Why is this a better alternative to going to private equity or venture capital?
Well, private equity or venture capital has a great formula, and their formula is to take as much as possible, take a board seat, and typically what they do is they squeeze out the founders because they dilute them.
Yeah, there's a lot of that. A lot of friends that have been squeezed out.
Yeah, and they dilute them. And so the other problem with venture capital and private equity is their formula is clawbacks. So you come to me and you say, I have this great company, this great idea. We're going to do 10 million this year, 100 million next year, 500 million the year after. Private equity and VCs love that kind of conversation. They say, oh, great. I'll tell you what, we're going to give you a great valuation if you hit those numbers. And in the fine print, there's a clawback. If you don't hit those numbers, we get more stock. And then there's also provisions that say we can put in more money at a discount. So in essence, in some of these situations, they actually are shorting the stock to make it go down because they have a contract that says they can buy in at a discount to market at 20%.
Yeah.
We call that a death spiral. So
it's a big conflict of interest. No, I had a friend who had a device company, and they sold for $100 million, but he ended up with nothing because of some of these provisions and the liquidation preferences and everything.
Exactly.
Talk about what you're seeing today as we're entering this age of AI. What kind of companies are you excited about? And what capital structure? You just mentioned some of the issues with venture capital and private equity. So what kind of companies today should be looking at these types of Reg A pluses that you do?
Well, I would say the earlier stage companies that need capital to grow, but that's a good question. So I have this philosophy I call corporate finance plan. And a corporate finance plan is I ask my clients, what is your end goal? IPO, bought out, whatever. But now what we want to do is we want to work backwards from there to figure out how much money they need to get to that goal without diluting so much that the stock price is selling for $1 or under when you get to that point. So having a corporate finance plan would say to me, well, I need $1 million today or 5 million. That'll take me to the next hurdle, which then I think I'll need 50 or 100, whatever that number is. And I think that's the best way to look at it. There's too many times, like you were mentioning that you invested in a company at 43 cents a share. From 43 cents a share to getting your stock price to a point where you can actually trade it on public markets, you want to be at least $10. Because if the stock goes down below 5, you're facing delisting. So you have
Delisting,
to maintain $5. And the most important part of that is a lot of the brokerage firms don't let their brokers trade stocks under $5. They call them penny stocks for compliance reasons.
So what's the sweet spot? So at what point, I mean, you got to kind of make sure your stock price, your share price is within those ranges. But at what point should somebody say, instead of going to angel investors or friends and family or family offices, that VC and PE is going to be too much of a hit, that there's this middle ground that they should be excited about working with you?
Yeah, one of the strategies I use as well is called Reg CF, regulation crowdfunding. And the beauty of Reg CF is now you can raise up to $5 million. And the big benefit of that is, unlike traditional, what we call Reg D financing, which accredited investors with only a small handful of non-accredited allowed, with Reg CF, you're allowed to sell to all non-accredited investors as well as accredited. And most importantly, you're allowed to do public advertising, unlike a Reg D, where you can't do public advertising. And so what that does is, while you're advertising to get investors, you're also advertising your product to potential customers. And you can
Interesting.
increase sales while you're actually bringing in investors.
Well, that's very exciting. I think a lot of people will be excited about that. So if somebody wants to work with you, what's the best way to do it? Reach out on LinkedIn or call you at the number on your website?
Either call me or check out my website, tyconpartners.com. And you can click on the link to book an appointment. It's very easy.
Perfect. Well, thank you so much for joining us today.
Thanks for having me. Enjoy your day.